Hello, everyone. My name is Denise Appleby. Thanks for joining me for this revisitation of some of the key points of Secure Act 1.0 and some updates on changes that have been made since then. I want to talk about not just the technical aspect, but some of the operational considerations as well. And as we go along, if you have questions, please submit your questions. If I don't get to answer all your questions during the session, you can always send me an email afterwards. Just some general disclaimer, copyright, a little bit of information about me, but we want to get into the real important issue here today. What is it that we hope to learn? One of the most important topics for recent years is what are the distribution options for beneficiaries? Because significant changes have been made to those rules. So if you have not been, if you were in the industry before and you took a break in 2020 and are just coming back, man, there are a lot of things that you need to catch up on so that you can help your clients. And to that end, we're going to be talking about what are the distribution options for beneficiaries. The answer depends on many factors, including what is the class of beneficiary that we're talking about. There are new opportunities for avoiding the excise tax that applies when someone doesn't take their RMD by the deadline. That applies to owners and beneficiaries with inherited accounts. And, you know, we're going to drop a little bit of sprinkle on some of the tax saving strategies that we should take into consideration for spouse beneficiaries. Now, I want to add a note of caution. And you should say this to your clients too, when you have conversations about them and their retirement accounts. The rules change often. And for that reason, when a client is about to make a significant decision or engage in a transaction with their retirement account, they should call you first. Because even though you are going to do your best to make sure you provide them with updates on changes that affect their retirement accounts, sometimes those notifications fall through the crack as people get busy. And so to help ensure that they are following the rules and avoiding mistakes and taking advantage of tax saving strategies, they should call you before they engage in any of those transactions, whether you are their tax, financial, or legal advisor. Now let's start with some of the key changes. We cannot talk about changes without going back to 2019 when the Secure Act 1.0 was signed into law on December 20, because for recent years, that is where it started. Secure Act 1.0 increased the starting age for RMDs from 70 and a half to 72 for those who reach age 70 and a half after 2019. It also introduced the new class of beneficiary, an eligible designated beneficiary. And now we know an eligible designated beneficiary is the only one that can take distributions over their full life expectancy. Because as provided under Secure Act 1.0, plain designated beneficiaries can no longer take distributions for more than 10 years. And guess who's also subject to a 10-year rule? A successor beneficiary. They have a maximum period over which to continue taking distributions after they inherit the IRA from the original primary beneficiary. So let's take a look at the classes of beneficiary. Your client who inherits a retirement account can be a designated beneficiary, which would be the case if they are a person or a qualified see-through trust. If your client is a designated beneficiary and is also the surviving spouse of the IRA owner, a child of the IRA owner who has not reached the age of 21, disabled, chronically ill, or not more than 10 years younger than the IRA owner, then that person is considered to be an eligible designated beneficiary. Now, when I say IRAs, I'm including employer plans as well, because the rules for distributions are pretty much the same. There are some exceptions, and when those exceptions apply, I'll make sure I make that distinction. Now, for purposes of an eligible designated beneficiary, that status is determined at the time of the IRA owner's death. For instance, a beneficiary who is not an eligible designated beneficiary when they inherited the account, but they become disabled later on or chronically ill, they cannot be an eligible designated beneficiary. Why? Because they were not an eligible designated beneficiary at the time of the IRA owner's death. And if a beneficiary is not a designated beneficiary, then they are a non-designated beneficiary. We also want to ask the beneficiary the question, are you the primary beneficiary of the original IRA owner? Why is that? Because if they're not, they are considered a successor beneficiary, and the distribution rules for a successor beneficiary are different. The question becomes, what is the limitation and the requirements that apply to a successor beneficiary? Don't worry, I'm going to be talking about that later on. Then we have the proposed regulations that were published on February 24th, and that came with some shockers. The most impactful one is the contradiction of the 10-year rule as we thought it was. And yeah, I'm including myself in that. So here's what happened. When Secure Act 1.0 was published, it said that the 10-year rule applies to anyone who is just a plain designated beneficiary, not an eligible designated beneficiary. And under that 10-year rule, distributions were optional from years 1 through 9, and the account had to be emptied by the end of year 10. It also said that rule applies regardless of what age, regardless at what age the IRA owner died. And for us, that seemed clear. You are a designated beneficiary, then the 10-year rule applies. Distributions are optional from year 1 through 9. You got to empty the account by the end of year 10. But the proposed regulations say no. What you guys are forgetting is that there is an at least as rapidly rule. And under that at least as rapidly rule, once the IRA owner already started taking RMDs, you cannot turn off that pipe. So any beneficiary that inherits an account from someone who dies on or after their required beginning date has to continue taking RMDs. The only question is, at what rate should those RMDs continue? And the rate is usually over the life expectancy of the beneficiary, could be over the life expectancy of the decedent, if depending on the beneficiary profile. The bottom line is, you can't stop that, has to continue. The proposed regulations also explain that there's a deadline for a spouse beneficiary to treat an inherited IRA as their own, and limits rollovers by spouse beneficiaries in some cases. More to come on that. Now, what we have learned as a result of the proposed RMD regulations is that there are 3 10-year rules. The first one applies when the IRA owner dies before their required beginning date. Under that 10-year rule, distributions are optional from years 1 through 9, and the account has to be emptied by the end of year 10. That applies to a regular designated beneficiary. That's the only option for them. It's also an option for an eligible designated beneficiary, where the eligible designated beneficiary could be subject to this 10-year rule or take distributions over their life expectancy. In some cases, this option is going to be driven under the terms of the plan document. Some will default to one of the two. Some will give the eligible designated beneficiary the option to choose one or the two. So you always want to check the terms of the plan document to see whether or not your client needs to take action to elect the option that they want. And usually in those cases, a deadline applies to when the election must be made. The election is usually December 3rd. The deadline is usually December 31st of the year following the year in which the IRA owner dies. 10-year rule number 2 applies when the IRA owner dies on or after the required beginning date and the beneficiary is a plain designated beneficiary. Under that 10-year rule, the designated beneficiary must take annual RMDs beginning the year following the year in which the IRA owner died, and the account has to be emptied by the end of the 10th year. 10-year rule number 3 applies when an eligible designated beneficiary dies. This applies to the successor beneficiary who must continue taking annual RMDs from the inherited account if the original beneficiary was taking distributions under the life expectancy method. The eligible designated beneficiary is then subject to a maximum period of tenure within which they have to fully distribute that account. One of the reasons why we want to always double check to see, well, are you the primary beneficiary or are you a successor beneficiary? The proposed RMD regulations also explained that, contrary to what a lot of us believe, the not more than 10 years younger status is not counted in calendar years. So, we wouldn't say, oh, you were born in 1953 and your beneficiary was born in 1963. That's an automatic not more than 10 years younger. What they explained was that we have to use the exact date of birth to make that determination. For example, in this example that I included here, Susie's date of birth is October 1, 1953. Her beneficiary would be considered not more than 10 years younger if that beneficiary was born on or before October 1st, 1963. So that automatically too includes beneficiaries who's older than Susie. Have you had conversations with clients about the not more than 10 years younger and have made a determination that they are an eligible designated beneficiary because of this rule? Now, if it was close like this, then you might have to go back and revisit whatever information you provided to that client to make sure that they are in fact an eligible designated beneficiary or did not miss an opportunity to be an eligible designated beneficiary. Now, I talked about the at least as rapidly rule, right? And for beneficiaries who were subject to the 10-year rule and find out that, hey, they had to take annual RMDs after all. Now, when the IRS published the proposed RMD regulations, they got a lot of feedback from a lot of people who were upset because we were telling individuals that they didn't have to take annual RMDs from the inherited accounts if they were designated beneficiaries. And so because of this clarification by the IRS, people were saying, but listen, we didn't take RMDs for 2021 and 2022 because of what Secure Act 1.0 appeared to say. And now you're telling us that we're going to have to pay you a 50% excise tax because we didn't take those RMD amounts? And in response to that, the IRS published Notice 2022-53 and said, you know what? You were right. And because we wronged you, we're going to automatically waive the 50% excise tax for any RMDs that were not taken for 2021 and 2022, providing the beneficiary was subject to the 10-year rule and the annual RMD requirements. So before we tell anyone that they qualify for this waiver, we have to make sure that they fall into that narrowly defined class of beneficiary. So what if someone already paid the excise tax for 2021? Then they can claim for a refund and the IRS will honor that request. So you got to be careful here when you're having conversations about this waiver. Who does it really apply to? We have already established that it applies to a plain designated beneficiary where the account owner died on or after the required beginning date, and the plain designated beneficiary is subject to the 10-year rule and is also required to take annual RMDs. Now, this does not apply to Roth IRAs because there is no required beginning date for a Roth IRA owner, right? But who else does this affect? This affects a successor beneficiary where the eligible designated beneficiary died and was taking distributions under the life expectancy method, and the successor beneficiary was therefore required to take annual RMDs and is also subject to the 10-year rule. So there are two classes of beneficiaries that benefit from this automatic waiver. Secure Act 2.0, signed into law on December 29, 2022, is another recent change that introduced new RMD ages. So now we're on a schedule. I'm going to talk about what the ages are later on. It reduces the excise tax to RMD failures, and it implemented new statutes of limitation on certain excise taxes. And it also added some exceptions to the 10% additional tax or early distribution penalty for distributions that are taken before age 59 and a half. Now let's talk about some of the new IRA protection provisions that I really like. And the reason why I like this is that these kind of penalties can really put a dent into an individual's retirement account. You spend years of savings and you make one mistake and a chunk of it, and sometimes all of it, can be gone because of excise taxes and penalties. So the first one is the reduction in the excise tax that applies when someone doesn't take their RMDs. That used to be 50%. Effective 2023, it's reduced to 25%. And guess what? If it's corrected during a correction window, that's even reduced even further to 10%. Now you want to pay attention to this correction window, because one of the questions I get from advisors is, well, Denise, do we have to do anything? Can we just, look the other way and pretend we don't know that they missed the RMD deadline? And I usually say no. Make sure to correct it. You don't want the IRS to contact your client and say, hey, you didn't take your RMD. We have an issue, because in that case, it's less likely that they are going to waive the excise tax. But if it's corrected during the correction window, if the IRS sees that steps have been taken to correct the RMD shortfall, then they're more likely to waive the excise tax. Not only that, the reduction to 10% is contingent upon certain steps being taken during that correction window. So another incentive to encourage clients to correct RMD shortfalls. And of course, this applies to both IRA owners and beneficiaries. Another question that I get to is, well, Denise, I'm being told that because there's an opportunity to reduce the excise tax to 10%, the IRS won't waive the excise tax. I'm not aware of anything like that coming from the IRS. And until the IRS comes out and says that they're no longer waiving the excise tax and RMD failures, I encourage you to continue filing for a waiver or requesting a waiver by filing Form 5329 if the deadline was missed due to reasonable error. Let's talk about this landmark case here, where a taxpayer owes the IRS $8.5 million in excise tax stemming from the 6% excise tax that applies to an excess contribution that is not corrected by the IRA owner's tax filing due date plus extension. Now, you know that if the excess contribution to the IRA is not corrected by the deadline and the excess remains in the IRA, the 6% excise tax accrues every year. But that's not the case if Form 5329 is filed, because Form 5329 starts the statute of limitation. And guess what? A lot of people weren't aware of that, as it was in the case of this taxpayer, which is why they owe the IRS so much in that 6% excise tax. But let's be real, who knew about the requirement to file Form 5329 to start the statute of limitation for the 6% excise tax and also for the excise tax that applies to RMDs? Not many people. And so what we learned from Secure Act is that that was an unfair requirement because of the lack of knowledge. And so instead of the statute of limitation starting when someone files Form 5329, it is now started when the individual files their tax return, because everybody files their tax return, right? Everybody who's required to. Let's talk about some of the Roth provisions under Secure Act 2.0. The most popular one is 529 to Roth conversions, where an individual, a beneficiary who has assets remaining in their 529 plan after they've finished their educational pursuits and will no longer have qualified education expenses for which they can use these amounts. The issue with that is when they take distributions of those amounts, the earnings portion is going to be subject to income tax plus the 10% early distribution penalty if they don't qualify for an exception. And so under Secure Act 2.0, there's a provision where they can move up to $35,000, which is a lifetime limit, to a Roth IRA where the amount would eventually be eligible for tax-free distributions, no income taxes, no 10% penalty, as long as the individual qualifies. Now, you got to be careful here because not every 529 plan is eligible for this Roth conversion. The 529 plan has to have been maintained for at least 15 years. So no, don't think, oh, I can stuff the money in there during the last 5-year period and get those amounts over to a Roth IRA, because any amount that has not been in the 529 plan for at least 5 years before the rollover to the Roth IRA cannot be included in that rollover conversion. Also, you cannot move the $35,000 in 1 year. The maximum amount that can be moved is subject to the IRA contribution limit that's in effect for the year. And when making that determination of whether or not the amount is within the IRA contribution limit, you have to add that to any other traditional Roth IRA contribution that the individual made. I wrote an article about this for Morningstar where I dig deep into the rules, so please feel free to go take a look at that article. And again, once the assets hit the Roth IRA, they become subject to Roth distribution rules. And this provision is effective for 2024. Now, here's a question that came in. Denise, can the parent move the 529 to their own account and then convert it to a Roth IRA so that they benefit? Okay, there's another one. So I'm just gonna roll this one into that as well. Can we transfer it from one kid to another kid so that the other kid gets the 15-year period? Well, here's what I'll say to these questions as it relates to the 529 plan. We should really wait for guidance from the IRS, because these questions are not uncommon. I get a lot of questions from individuals who are trying to circumvent the rules as they are right now. But the IRS a few years ago published proposed regulations where they found out that individuals were using strategies that could circumvent some of the limitations that apply to 529 plans. And they call those abusive transactions and threatened people who thought they could use those strategies. Would these questions that you're asking be considered abusive? I don't know, but it's risky. So one of the things that we can do is ask the IRS to be certain, right? Hopefully they'll publish proposed regulations soon so that we can ask those questions in during the comment period. I wouldn't advise getting a private letter ruling on this because private letter rulings cost $12,500 plus professional fees. It might not be worth it for $35,000, but that's a personal decision. Roth, SEPs, and Simples. Now, before Secure Act 2.0, we could not make Roth contributions to SEP and Simple IRAs. Now that has changed, where salary deferral contributions and employer contributions can be made to Roth IRAs as part of a SEP IRA and Simple IRA arrangement. Now remember though, for SEP IRAs, salary deferral contributions are not permitted unless the SEP is a salary deferral SEP that was established before 1997. Now, one of the questions that we have to ask is, so this is great. Now we can make Roth contributions to SEP IRAs and Simple IRAs, but is it right for every client? Of course, the answer is no, because one has to do a suitability assessment to determine which is suitable for a client, traditional or Roth. And sometimes it makes sense to straddle the fence and give your client like half and half or whatever percentage. Doesn't have to be half and half, but sometimes it's better for a client to benefit from both by putting some in one account and some in another. The challenge with this is, even though this provision is currently effective, I don't see any custodians offering it. And that is expected because they didn't have enough time to make the changes to their tax reporting system, their ancillary documentation, their IRA agreements to cover these provisions. And the IRS haven't had time yet to issue guidance on how these transactions should be handled, including from a tax reporting perspective. Right, so we still have to wait for that, even though the provision is in effect. Practically speaking, can we do this right now? Another good change, no RMDs for designated Roth accounts, which, as you know, is Roth 401ks, Roth 403bs, and governmental Roth 457bs. One of the reasons why the RMD rules apply to retirement account owners is so that the IRS can get the deferred income tax that's due on those amounts. And so it made sense that no RMD rules apply to Roth IRA owners. Why then did it apply to designated Roth accounts? Makes no sense, right? Well, now we have equalized designated Roth accounts and Roth IRAs. So both of these accounts are not subject to RMDs for the account owners. RMD rules still apply to beneficiaries of these accounts. But the no RMD rule for designated Roth accounts is effective 2024 and after. So does not apply to 2023. Your clients who are of RMD age for 2023 have to take their 2023 RMD from their designated Roth accounts. Now, if someone's first RMD year is 2023, we know they can take that RMD as late as April 1, 2024. And so you might be thinking, oh, I'm going to tell my client not to take that in 2023. They can wait until 2024 to take it. And then maybe they don't have to know. Secure Act 2.0 made a point of explaining that even if the RMD can be deferred until 2024, it still has to be taken because it's not a 2024 RMD, and this newer provision applies to 2024 and after RMDs. Roth employer matching and non-elective contribution to qualified plans. Now, before Secure Act 2.0, employer contributions had to be made to the traditional pre-tax side of these plans. But now under Secure Act 2.0, an employer may allow an employee to elect to have these contributions made to their Roth accounts. Of course, the same question arise as those that apply to the SEP and Simple Roth. Is it suitable for the client? And can we even do it now? Because are these documents ready to accept these contributions to Roth accounts? Catch-up contribution rules under Secure Act 2.0. We know that individuals who are at least age 50 by the end of the year are eligible to make catch-up contributions. But effective 2025, for clients who are ages 60 to 63 as of the end of the year, they have new catch-up contribution limits. For those individuals, their catch-up contributions can be as much as $5,000 for simple accounts and as much as $10,000 for 401ks and 403b accounts. Now, there are other restrictions. It's the greater of for instance, for simple, it's the greater of $5,000 or 150% of the dollar amount in effect for 2025. For 401ks, it says 2024. So I am confused by one provision being for 2024 and one being for 2025. So hopefully the IRS will clarify that soon. New exceptions under Secure Act 2.0. I had a conversation with a client a few days ago, and he was concerned about a client that he had who was terminally ill. And she had to take distributions from her IRA, but she was under age 59 and a half. And so she was going to be subject to the 10% early distribution penalty. Now, she didn't qualify. She did not qualify for the disability exception because she was still working. She was still working at a regular job. And he called me, he said, Denise, you know, this is not fair. This woman is terminally ill. And now we're telling her that she's going to have to pay a 10% early distribution penalty. And I said, well, I have good news. Under Secure Act 2.0, if her physician certifies that she has an illness that is expected to result in death within 84 months or less, then she qualifies for a waiver of the 10% early distribution penalty. So that was some good news for that client. And he says to me, Denise, 84 months, that's not bad at all. But what if she lives past 84 months? Well, she still qualifies. There's no retroactive assessment because it says reasonably expected to result in death. Doesn't say guaranteed to result in death. So if your client is terminally ill, have them get that certification from their physician so that they qualify for the exception to the 10% early distribution penalty. Another added addition to the exception is corrective distributions of excess contributions. Remember when someone did a return of excess contribution by tax filing due date plus extension from an IRA, they had to include any attributable earnings or losses. And if there were earnings, the earnings was included in income, so it's subject to income tax, and it was also subject to the 10% additional tax, early distribution penalty, if they were under age 59 and a half. unless they qualified for an exception. That amount no longer is subject to the 10% early distribution penalty. Now let's get into it and talk about RMDs for account owners. Client walks into your office and say, well, come on, tell me really, when am I supposed to start taking my RMDs? Now you have to say to the client, well, let's start with your date of birth. When were you born? Because that's going to determine their first RMD year, right? If someone was born June 1949, June 30, 1949 and earlier, they should have started taking RMDs the year they reach age 70 and a half. For those who were born July 1st, 1949 to December 31st, 1950, their RMD year, their first RMD year is the year they reach age 72. For those who were born January 1, 1951 to December 31st, 1959, it's age 73. And for those who were born January 1st, 1959 and after, it's age 75. And right now you're saying, did you make a mistake, Denise? Because you included 1959 in both the age 73 and 75 category. No, I didn't make a mistake. There is an error in the language of Secure Act 2.0 where 1959 is included in both categories. And we expect the IRS to issue technical corrections for that. But the good news is that we have several years before this becomes an issue. So that gives the IRS time to issue that technical correction. Now, for employer plans, the first RMD year can be deferred past this date until retirement if permitted under the plan. Don't assume that because someone is working for an employer and they participate in that employer's 401k plan, they can defer RMDs past this age. The regulations allow it, yes, but the regulations also allow the employer to say, I don't care what the regulations say, once you get to that age, you got to start taking your RMDs. And I'm telling you this because if a client wants to know, do they have to start taking their RMDs? We have to say, well, let's check with the plan administrator to see whether or not you have to, or if you can wait until you retire. And of course, your clients who are self-employed individuals with their solo Ks and profit sharing plans and pension plans, they are considered 5% owners, which means they own more than 5% of the business. And the option to defer RMDs past the required beginning date generally does not apply to these individuals. So they generally have to start taking their RMDs at the ages at which we just discussed. When must the first RMD start? By April 1 of the year that follows the first RMD year for an individual. It's important to know an individual's required beginning date for reasons that include making a determination if they died before the required beginning date or not. And that's because whether an IRA owner dies before the required beginning date drives the distribution options that are available to a beneficiary. Now, we want to talk about individuals who reach age 72 in 2023. Why is that? Those individuals do not have an RMD for 2023. So what's the problem then? Well, because Secure Act 2.0 was signed into law so late in the year, some IRA custodians didn't get enough time to stop the RMD notice that they send out to IRA owners to say, hey, you reached age 72 this year, you got to take an RMD for this year. And so some clients got that RMD notification. And my clients are asking me, Denise, what should my client do? Well, tell them to chuck it in the garbage because those notices are invalid. Someone who reached age 72 in 2023 does not have an RMD for 2023. But the issue is some of these clients, because they're like me, when I get a notice that says I have to pay a bill or something similar, I do it right away. I don't want to wait. And so some of these individuals, as soon as they got that notice they took what they thought was an RMD. And some of them are now coming back to the advisor to say, can I put it back? Because I didn't want to really take it in the first place. I only took it because I thought I had to. Well, in that case, you can have the client roll it over to the IRA as long as it's not going to break the 1 per year IRA to IRA rollover rule. Now, generally, the rollover must be completed within 60 days. But if they miss the 60-day deadline, that's a very good reason to apply the self-certification method, where you can roll over an amount past the 60-day deadline if they qualify for a waiver. And you can get details on how this works in Revenue Procedure 2020-46. So that's Revenue Procedure 2020-46. It includes a list of reasons for which an individual would qualify for this self-certification option and the step-by-step process on how it should be done. Now, what if your client is about to break the 1 per year IRA to IRA rollover rule? Then if they are a participant in an employer plan, like a 401k, they can roll over the amount to that plan. If not, they can roll it to a Roth IRA, because that would be a Roth conversion, and Roth conversions are not subject to the 1 per year IRA to IRA rollover rule. Now, at this point, you're probably saying, but Denise, for the Roth conversion, the amount's going to be included in income, and that's true. But you know, it's the better of both options. If they don't roll it over, it's going to be included in income. If they roll it to the Roth, it's going to be included in income. But with the Roth, any subsequent earnings will be tax deferred and eventually tax-free when they become eligible for a qualified distribution. Non-aggregation of RMDs with annuities, another provision that became immediately effective. Why is this important? Because before Secure Act 2.0, if an individual had 2 accounts that could otherwise qualify under the RMD aggregation rule, and one was an annuitized account, the other was not an annuitized account, then they couldn't aggregate RMD. So let me tell you what RMD aggregation means. Client has a traditional IRA that's not annuitized, and they have another traditional SEP or simple IRA that's not annuitized. You calculate the RMD separately for these accounts, but you can total the amount and take it from one or more of those accounts. But even where RMD aggregations were permitted, if you had multiple traditional SEPs and simples, if you had multiple 403Bs, if you had multiple accounts on the one employer qualified plan, then you could aggregate RMDs for those accounts, unless one of the accounts is an annuitized account. And the problem with that is when you look at the annuity amounts, in many cases, they were enough to actually cover RMDs for both accounts. But the problem was annuity aggregation was not permitted until now. How do we calculate these amounts? No one knows. But the language in Secure Act 2.0 says, apply on your reasonably good faith interpretation of the provision to apply this rule until the IRS issues official guidance. So this is a good change. Classes of beneficiaries. Earlier on, I explained the classes of beneficiaries, so I won't repeat that, but I wanted to include this slide here as a reminder, since we're going to be talking about the distribution options that apply to beneficiaries. And let me take this opportunity to remind everyone, because I get the question, well, what about Roth IRAs? Beneficiaries of Roth IRAs are subject to RMDs as well, but because Roth IRA owners are not subject to RMDs, there's no required beginning date. And so in all cases, when a beneficiary inherits a Roth IRA, the rules that apply are the rules that apply when someone dies before their required beginning date. So even if the Roth IRA owner is 93 years old, you're going to apply the same rules as you would to someone who died at, say, 69 years old. Before we start talking about the distribution options for beneficiaries, let's talk about the RMD for the year in which the IRA owner dies. If the IRA owner died before taking the RMD for the year of death, then the beneficiary must take that RMD. It's going to be calculated as if the owner lived through to the end of the year, but it's going to be included in the beneficiary's income. Now, before the proposed RMD regulations were issued, I'm mixing up my Secure Acts now. Before the proposed RMD regulations were issued, we used to tell individuals correctly, we used to tell beneficiaries, hey, you got to take this by the end of year of death, or you're going to be subject to the excise tax. And technically, the deadline is still the end of the year of death, but the excise tax is waived if this RMD is taken by the beneficiary's tax filing due date for the year of the owner's death plus extension. So your client now has some wiggle room to avoid the excise tax on the RMD failure automatically. How do we know what the distribution options are that are available to beneficiaries? One of the questions is, are you the primary beneficiary? Right? And the goal here is to make sure whether they are the primary or a successor beneficiary, because the rules are different, right? And of course, you want to ask some other questions too. Did the account owner die before 2020? Did the account owner die before the required beginning date? So you're going to ask, what's the date of birth and date of death of the account owner, right? Is the beneficiary a non-designated beneficiary, designated beneficiary, or eligible designated beneficiary? And you also want to know if they're a spouse or a non-spouse, because the distribution options are driven by the responses to these questions. So let's take a look at what the distribution options are. If the IRA owner died before 2020 and the beneficiary is a designated beneficiary, it's the 5-year rule or over the beneficiary's life expectancy if death occurred before the required beginning date. Now, the life expectancy distribution must begin by December 31st of the year following the year of death and is taken every year after. But if the beneficiary is a surviving spouse, they can defer starting life expectancy distribution until the decedent would have reached their RMD age if that's a later year. But if the account owner died on or after the required beginning date, distributions will be taken over the longer of the remaining life expectancy of the account owner or the life expectancy of the beneficiary. If the beneficiary was a non-designated beneficiary, the only option is the 5-year rule if the account owner died before the required beginning date or over the remaining life expectancy of the decedent if the account owner died on or after the required beginning date. And those rules did not change for a designated beneficiary under Secure Act 1.0. Now, for an eligible designated beneficiary under Secure Act 1.0, if the account owner died before the required beginning date, they have two options: the 10-year rule or to take distributions under the life expectancy rule, where under the life expectancy rule, distributions would begin the year following the year in which the IRA owner died, or if it's the beneficiary is a spouse, it can be deferred past that date until the account owner would have reached their RMD age if that's a later year. For the eligible designated beneficiaries, the life expectancy rule or the 10-year rule, how do we know which applies? In some cases, the eligible designated beneficiary can choose. In some cases, there is a default provision. I'll talk more about that shortly. If the account owner died on or after the required beginning date, distributions are taken over the longer of the beneficiary's life expectancy or the decedent's remaining life expectancy. If the beneficiary is a plain designated beneficiary and the account was inherited after 2019, then if the owner died before the required beginning date, it's the plain 10-year rule. Distributions are optional from years 1 through 9. They died on or after the required beginning date, then it's a combination of the 10-year rule and the life expectancy rule, where annual RMDs must be taken over the beneficiary's life expectancy, and the account must be fully distributed by the end of the 10th year. Now, this is high level, right? There's some other things that we need to think about, especially for spouse beneficiaries. For instance, the life expectancy recalculated or non-recalculated? Generally, when you're using the life expectancy of the decedent, it's non-recalculated. The only time, and also if you're using the life expectancy of a non-spouse beneficiary, the only time you recalculate the life expectancy is if you're using the life expectancy of a spouse beneficiary. And recalculated means that you go to the life expectancy table each year to figure out what the life expectancy table, to figure out what the life expectancy is. Where non-recalculated means you determine the life expectancy in the determination year and you subtract 1 for each subsequent year. Now, here's a question that's coming in. How do we know which life expectancy table to use? There are 3 life expectancy tables. The single life expectancy table, which uses the age of the beneficiary, and that's used only for inherited accounts. Then we have the uniform lifetime table, which assumes that the beneficiary of the account is 10 years younger than the account owner. That's used to calculate RMDs for retirement account owners, not beneficiaries. And then we have the joint life survivor table, which is used if the spouse of the account owner is the only primary beneficiary and is more than 10 years younger than the account owner. In those cases, the true ages of the spouse and the beneficiaries used, and that produces a lower RMD than the uniform lifetime table. Now, bear in mind that an IRA custodian that calculates the RMD for an account owner can choose to use the uniform lifetime table even when someone's eligible for the joint life expectancy table. So if your client's eligible to use the joint life expectancy table and the IRA custodian uses the uniform lifetime table, you can ignore that and calculate the RMD using the joint life expectancy table to get the lower RMD. Now, part of what I talked about here is that if the account owner died before the required beginning date and the beneficiary is an eligible designated beneficiary, where the account was inherited after 2019, there are 2 options, the life expectancy rule and the 10-year rule. Now, I see a lot of cases where 401k type plans are defaulting to the 10-year rule, used to be the 5-year rule. And what do you do in that case if your client is eligible for both, but the plan is saying to the client, I'm going to kick you out in 10 years. I don't care if you could have had the option to take distributions over your life expectancy. In that case, your client must do a direct rollover of that account to an IRA, an inherited IRA, that allows them to take distributions over their life expectancy. And that rollover must be completed by December 31st of the year of death. Let's take a look at 60-year-old Jane, whose brother died in 2023 at the age of 65. And she inherited a 401k account from him at $500,000. Now you're thinking, oh, that's a lot of money. I want Jane to be able to take it over her life expectancy. Why? Because she's an eligible designated beneficiary and she can. How do we know that? She's 60, her brother is age 65, so she's not more than 10 years younger. But the plan is saying, oh, no, we're only offering the 10-year rule. If Jane wants to use a life expectancy method, Jane must move the assets as a direct rollover to a beneficiary IRA that allows her to use a life expectancy option by December 31st, 2024. Now, if it's a spouse beneficiary, they can use the indirect rollover method, but you don't want to do that because there's going to be a 20% withholding on any taxable amount. And if the spouse is under age 59 and a half, the indirect rollover would have to be done to their own IRA, not a beneficiary IRA, and we would have an issue with the 10% early distribution penalty, which I'm going to be talking about later on. Now, if you're a client subject to the 10-year rule, one of the questions that I often get is, well, should they wait until the end of the 10-year period, or should they take a little bit each year? For a Roth account, the answer is easy because at the end of the 10-year period, the distribution is going to be tax-free. We know no penalty is going to apply because it's a distribution from an inherited account, and those distributions are automatically exempt from the 10% early distribution penalty. But even if your client can wait until the end of the 10 years to take the distribution, and it's a traditional IRA, do we want to have them do that? The answer comes down to taxes, right? And it might make sense for some to spread a little bit here and spread a little bit there to help mitigate the income tax that's going to be owed. In this example here, you'll see where someone inherited an IRA valued at $250,000 and assuming a return of 5%. In this case, the owner died before the required beginning date, so they don't have to do anything until the end of the 10 year unless they want to. And if they don't, then in the 10th year, the distribution is going to be $407,000. The results might vary depending on which calculator you use, because some calculators start calculating the interest at the beginning of the year, I've found, and some at the end of the year. But you get the picture, right? Do you want to have your client wait until the end of the 10-year period? Or do you want to do like this person who says, I'm going to split it in 10 and take a little bit each year so that they don't have that balloon distribution, which is going to pump them high over their regular income tax rate, threshold, I should say. Another provision under Secure Act 2.0 was that a spouse beneficiary can treat an employer plan as their own. Now be careful here. We know that applies to IRAs, that have always applied to IRAs. But for IRAs, it means putting the assets in the spouse beneficiary's own IRA and have the RMD rules apply as if the spouse beneficiary was the owner from the get-go. They can make contributions to that account. They can make rollover contributions to that account. For employer plans, the treat as own option is a little bit different. This is purely for RMD purposes, where it allows RMDs to be calculated using the uniform lifetime table, whereas it used to be only the single life expectancy table over the spouse beneficiary's life expectancy. So now the spouse beneficiary can make an irrevocable election to treat the inherited employer plan account as their own. The IRS may waive this irrevocability. Let's see what happens. There's no guidance yet. And then the RMDs for spouse beneficiary would begin no earlier than RMDs would have begun for the account owner. This is effective 2024. When can the election be made? We don't know that yet. We don't know how the election is made. I assume that they're probably going to piggyback off of existing election procedures that are in place, but let's wait and see. Let's talk about some planning opportunities for spouse beneficiaries. We know that spouse beneficiaries have options that are available to them that are not available to other beneficiaries. For instance, a spouse beneficiary who inherits an IRA can roll over that IRA to their own account under an employer plan. They can treat the inherited IRA as their own. And the question for you as the advisor, when the spouse beneficiary asks you what to do, is to think about the tax implications. If the spouse beneficiary is under age 59 and a half, and you think they might take distributions from the inherited account before reaching age 59 and a half, then you want to recommend that they keep those assets in a beneficiary IRA, because distributions from beneficiary IRAs are automatically exempt from the 10% early distribution penalty. For the beneficiary IRA, they can take distributions over their single life expectancy, and they can move it to their own IRA or employer plan later on. If the spouse beneficiary moves the assets to their own IRA, then the owner RMD rules would apply to them, including using the uniform lifetime table to calculate their RMDs. Now, we used to say to spouse beneficiaries, oh, you can elect to treat an inherited IRA as your own at any time. There's no rush. But now the explanations on the proposed RMD regulations say, nah, there is a deadline. And the deadline is the later of the calendar year in which the surviving spouse reaches their applicable RMD age, and the calendar year that follows the calendar year of the IRA owner's death. So, if a spouse beneficiary wants to make that election, then we got to make sure they are aware of the deadline. But they can also roll it over to their own IRA, even if they miss that deadline. But the question becomes, if they're choosing the rollover method, would there have been RMDs that they would have been required to take from the beneficiary IRA if they had chosen the life expectancy method? And this becomes an issue when the IRA owner dies before the required beginning date. Because remember, when the IRA owner dies before the required beginning date, the spouse beneficiary can choose a 10-year rule or the life expectancy rule. And what they found out was happening, and this used to happen with the 5-year rule too, so this applies here, a spouse beneficiary might choose the 5-year or 10-year rule and say in year 3 for the 5-year rule or in year 6 for the 10-year rule, they decide, oh, yeah, so I haven't been taking any RMDs because I'm subject to the 10-year rule, but now I want to roll it over to my IRA. And the proposed regulation says if that happens, then we got to calculate a hypothetical RMD that they would have been required to take had they chosen the life expectancy method. And that hypothetical RMD amount cannot be included in the rollover. So we got to be very, very careful here. Another question is, well, are you the primary beneficiary? Because if they say no, then it's a whole different conversation. If they are not the primary beneficiary, then they are considered a successor beneficiary. And what are the rules that apply to a successor beneficiary? We got to find out, did the IRA owner die before 2020? And what distribution options applied to that primary beneficiary? Here's why. And here's something that a lot of people, I would say, have forgotten. If the IRA owner died before 2020, and the beneficiary also died before 2020, and if the beneficiary was taking distributions under the life expectancy option, then guess what? The stretch IRA distribution strategy still applies to that beneficiary and also their successor beneficiary. So if that primary beneficiary had a life expectancy of 50 years, that 50 years continue to apply for the rest of the 50-year period. So we absolutely want to be able to make that determination by asking the right questions. In other cases, if the primary beneficiary was subject to the 5-year rule and dies, then the successor beneficiary has only what remained of the 5-year period. If the primary beneficiary was subject to the 10-year rule and died, then the successor beneficiary has only what remained of the 10-year period. But if the primary beneficiary is an eligible designated beneficiary that was taking distributions under the life expectancy option, or a designated beneficiary who inherited an account before 2020 but died after 2019 and was taking distributions under the life expectancy method, then the successor beneficiary is subject to a 10-year rule where they must continue to take life expectancy distributions based on the original beneficiary's age, and they have 10 years within which to fully distribute the account. Don't worry, I included a handout that summarizes the distribution options for eligible designated beneficiaries. And I have a whole lot of other free stuff on my website. So if you go to deniseappleby.com, you'll see links to where you can go and download free quick reference guides, including the new RMD quick reference guide that explains how the RMD rules work now, today. So let's talk about some of the advisor action plans. What are some of the things that you can do to help your clients stay on the right track when it comes to their distribution options? For beneficiaries, you want to create a beneficiary profile before advising your client. Ask the right questions so that you can give them the answer that applies specifically to them based on their beneficiary profile. And look for opportunities for tax-efficient distribution strategies. Do we spread distributions for the 10-year period? For a spouse beneficiary, is there an issue of the 10% early distribution penalty? And something I forgot to mention for spouse beneficiaries, if the account owner died before the required beginning date and is younger than the spouse beneficiary, then that's an opportunity for a spouse beneficiary to say, listen, I am not going to start taking distributions until the decedent would have reached their RMD age. Works great for an older beneficiary, because if they put it in their own account before that period, then they would start taking RMDs when they reach their RMD age. But if they leave it in the beneficiary account, they wouldn't have to start taking RMDs until the decedent would have reached their RMD age, which is better because the decedent is younger in this scenario, right? And once they're required to start taking RMDs, then they would move the assets to their own IRA. Why? Because then RMDs would be taken under the uniform lifetime table, which produces a lower RMD amount. And if the client misses the RMD deadline, then absolutely request a waiver of the excise tax if the deadline was missed due to reasonable cause. I'm telling you from personal experience, because I've helped a lot of tax professionals request waivers of these excise tax. And the only time I got a denial letter from the IRS was the IRS responded to say, oh, this client doesn't qualify for the waiver because we have already addressed this for them in previous years. Like, what? This was the first time this was happening to the client. And so the CPA and I had a discussion, and the CPA called the IRS. And guess what? The IRS said the person who handled that case is new, not familiar with the rules. They made a mistake, so they're going to have to send out a revised letter. Crazy, right? There was one other case where a CPA came to me with a denial letter, and we found out after I looked at the form 5329, I realized that it has been filled out incorrectly. So there's a little twist on how you filled out that section. Just remember, when you fill it out, in the end, where it says how much do you owe, it should be 0. I hope that helps you help your clients. There's so much that we could talk about when it comes to these changes, but we have only so much time because you got to get to work, right? And fun in some cases. And so what I did was to cover some highlights, some areas that I've been getting a lot of questions on. And to that end, let me take some of your questions. So let's see here. And I really appreciate you sending in these questions so that I can clarify anything that needs clarifying. Can a qualified charitable distribution be done from an inherited IRA? Oh yeah, another area that I would have loved to cover. So let's talk about what a qualified charitable distribution is. It allows an individual to donate up to $100,000 from an IRA to a qualified charity and have the amount be tax-free. There are certain rules that apply. The $100,000 limit is a per person per year limit. The amount has to be paid to the charity. It can be hand-delivered to the individual, but it has to be made payable to the charity. Can it be made from an inherited IRA? Yeah, as long as on the date that it's done, the individual is at least age 70 and a half. So whether it's from the individual's own IRA or beneficiary IRA, can't be done before the account owner is at least age 70 and a half, right? And it does not apply to employer plans, does not apply to an ongoing SEP or simple, which means that SEP or simple contributions were made to the plan for that year. So yeah, that's a long answer to your question, which is yes. If someone converts to a Roth IRA, does the 10% penalty apply to that conversion? Custodian reported it with a code 1. Here's why I think they reported it with a code 1. And I thank you for asking questions on topics that we didn't cover here, because you got that stuff already. Let's bring in other stuff. There are two ways to do a Roth conversion: an indirect conversion and a direct conversion. With a direct conversion, the custodian moves the assets directly from the traditional IRA to the Roth IRA. So they know it's a conversion. And if the account owner is under age 59 and a half, then that's reported with a code 2. Code 2 says to the IRS, this amount is exempt from the 10% early distribution penalty. But there's a second way to do a Roth conversion from an IRA, where you take a distribution from the traditional IRA and you roll it over to the Roth IRA within 60 days. That's an indirect conversion. With an indirect conversion, the custodian doesn't know that it was going to be a conversion. And so they're required to report that with a code 1 if the account owner is under age 59 and a half at the time of the distribution. So how do you fix that? The tax preparer must file Form 5329 to claim the exception. Good questions. Have a client with an IRA annuity and another IRA. How do we calculate it so the annuity covers the RMD for the other IRA? Yeah, we don't know how to do that yet. We're waiting for guidance from the IRS, but the IRS says, use your best judgment. So I actually had a real case like that. And what we're trying to find out from the annuity company is, can you tell me what the RMD could have been if you knew the fair market value of the account? And see, that's the crux of the issue, because when you're calculating RMDs, the formula requires using the previous year in fair market value. And when an annuity has been annuitized, there's no fair market value. So how do we come up with that? Use your best judgment. I'm sorry, that's the best answer I have right now, because that's the answer they gave us. My client started a Roth IRA in 2010. If they convert now, do they have to wait 5 years to take distributions? Well, distributions can be taken from a Roth IRA anytime. There's no reason to wait. But I think what you're asking is, do they have to wait before they are subject to income tax or the 10% early distribution penalty? And there's a long answer to that, but let me try to see if I can sum it up as quickly as possible. The first thing is, if your client's eligible for a qualified distribution, all distributions are tax-free and penalty-free. What's a qualified distribution? Go to retirementdictionary.com and search for that. It pops right up. But if your client's not eligible for a qualified distribution, then distributions are taken under the ordering rules, which means regular contributions come out first, conversions come out second. Now, if the conversion amount has not been in the Roth IRA for at least 5 years, then it's going to be subject to the 10% early distribution penalty unless they qualify for an exception, right? So are they under age 59 and a half? If yes, has the amount aged in the Roth IRA for at least 5 years? No penalty. No, then penalty applies unless they qualify for another exception. Then talk about earnings. Distributions of earnings are taxable and subject to the penalty unless an exception applies, unless the distribution is qualified. So let me quickly say what a qualified distribution is. A distribution is qualified if the Roth IRA owner has funded any Roth IRA for at least 5 years and is either disabled, age 59 and a half, or deceased, or withdrawing up to $10,000 for first-time home buyer purposes. Those distributions are tax-free and penalty-free. Can someone convert their RMD to a Roth IRA? No, because a conversion by definition is a distribution and rollover, and you cannot roll over an RMD. So no, they cannot convert their RMD to a Roth IRA. I think I answered this one, what RMD tables apply to a beneficiary IRA. It's the single life expectancy table. So we know we have 3 tables, and the single life expectancy table applies to a beneficiary IRA. If a 401k is rolled over to a traditional IRA, how long before the rollover amount can be converted to a Roth IRA? There's no waiting period, but the question is, why are they, if the intent is to have these funds converted to a Roth IRA, you don't need to put that in the traditional IRA anymore. It can go straight to the Roth IRA. Let me see. Is a spouse beneficiary required to use the 10-year rule? Not at all. The only time the 10-year rule could apply to a spouse beneficiary is if the account owner died before their required beginning date, in which case there would be 2 options, the 10-year rule and the single life expectancy rule, and the spouse can choose either of the 2. If the plan document defaults to the 10-year rule, they can get out from under that by moving the assets to a beneficiary IRA that allows the life expectancy rule. For the 2020 new rules for beneficiaries, must non-spouse beneficiaries take distributions every year? I would recommend that we go back to that slide where we talk about the distribution options, because whether the non-spouse beneficiary has to take annual RMDs or RMDs every year depends on several factors, right? If the non-spouse beneficiary is a plain designated beneficiary and the account owner died on or after the required beginning date, then yeah, they got to take annual RMDs and empty the account by the end of the 10-year period. And also, if they are an eligible designated beneficiary, they have to take annual RMDs, except in cases where the account owner died before the required beginning date and they're somehow subject to the 10-year rule instead of the life expectancy rule. You just talked about QCDs. Can someone make a QCD and still make contributions to their IRA? I think what you're getting at here is on the Secure Act 1.0, because the age cap, CAP, for making contributions to traditional IRAs was removed. Now we can have someone making a contribution and also doing a QCD in the same year. And there's a provision that prevents double dipping. That provision says, in effect, that the amount that you contribute to your traditional IRA, if you distribute that amount as part of your QCD, then the amount that's excluded from income does not include the traditional IRA contribution amount if the traditional IRA contribution was deductible, right? So now we know that QCDs can be made only if the IRA owner is at least age 70 and a half. So are they making deductible traditional contributions for the year they reach age 70 and a half and later? And if the answer is yes, now we got to do some mathematics and find out, does the QCD include any amount attributable to those deductible contributions? And if so, then we got to subtract that amount from the QCD to determine how much is excluded from income. So for a Roth IRA, must the beneficiary take annual RMDs? Heard that is a new requirement as of 2022. Actually, no. For a Roth IRA, if the beneficiary is an eligible designated beneficiary, where again, they have the option of the life expectancy or the 10-year rule, if they're subject to the life expectancy rule where distributions are taken over the beneficiary's life expectancy, then they have to take annual RMDs. It looks like that is it. Thank you so much for your time. I really appreciate the interaction. And again, if you have any questions strictly pertaining to this presentation and they're not of a client-specific nature, please feel free to send me an email. If it's about a specific client case, then we can talk about an arrangement where we do that as a consultant client. But thanks again. I appreciate your time. Enjoy the rest of your day.